Okay, it is just about 10 o'clock. It's 9:59, and it is Tuesday, so it's time for our Tuesday weekly webinar. Hello, everybody. Good to see you. Beautiful, beautiful day here in southeastern Pennsylvania. I hope it's beautiful where you are as well. Okay, so we're gonna begin with our normal. We got some updates and some upcoming things that I want to talk about, and then we have. I'm just checking my levels here. Okay, so and then we have. We're going to go over some questions that came into the Slott group that I found interesting, and also an article about the effect and how maybe to handle IRMA, income-related monthly adjustment amounts. Always a big topic when we're talking about financial planning and tax-efficient planning for sure, because IRMA should be considered a tax. And I've done a whole video about IRMA, and we'll make sure to link that in the description here. But if you haven't already, be sure to hit the like, subscribe, and notification buttons on the YouTube platform. I appreciate that. So I'm just writing a note here, IRMA, so I make sure to include that in our description there. So that's income-related monthly adjustment amount, and we're going to talk about that and how in the Slott Report today, and how maybe we can overcome it. Or avoid it, or deal with it. I've shared with you that we've developed a special calculator that we've referred to as the Wheeler calculator that helps us gauge the impact on IRMA whenever we're developing a financial plan. Okay, so it is April 16th. That means we've just passed a significant milestone. We talked about it last week. That was the tax filing deadline. So now you could have filed an extension, and that's not an extension of time to pay, but it's an extension of time to file. But there are some things that have passed, and that's your ability to contribute to a traditional IRA or a Roth IRA. Now we're talking about contributions, not conversions. So you wanted to make sure that your contributions amounts are done. And if you didn't do those contributions, I'm sorry, it's too late. Also, I didn't note this last week, but health savings accounts, you can do catch-up contributions for prior year in health savings accounts as well, but that is also passed. Your first payment for first quarter of 2024 was due if you do estimated payments. So that was due yesterday, and the next one is due June 17th. So mark that on your calendar if you make estimated payments. Upcoming events we've got our live classes starting next week. So April 25th and May 2nd start our Thursday series of classes, and April 30th and May 7th start our Tuesday series of classes. So that'll be held at Holy Family University. And I think I've shared with you that that this is likely to be the last time that this version of the Changing World of Retirement Planning will be presented here. So we've got a new platform that's being developed. I think it's going to be very good, and we'll see as it when it's released, and we'll see how it is. But I just in all the discussion I've had with the creator, David McKnight, I think it's going to be great. I've been talking to you about the movie that we're going to be screening, The Baby Boomer Dilemma. There's a change there. We were going to screen it in at the end of May, the 29th of May, but we've had a lot of interest, and I've been talking to some other people who have been showing this movie around the country, and we want to schedule 3 different nights. And the Newtown Theater, where I love to show these things, or I love to have events there, we couldn't fit it in with their schedule to have 3 nights, because I'm on the board of the theater, and we're doing that's why I say we're doing major renovations. Putting in new bathrooms, heavy excavation around the theater, and completely redoing the balcony. If you haven't visited the theater, you should. And if you have, plan on returning after the summer, because they're shutting down for a couple months during the summer. So the schedule's a little tight. But in the fall, we're going to have 3 showings of the Baby Boomer Dilemma. So to be determined what those dates will be, but I'll let you know. And another thing that we're working on for you is we're scheduling a webinar with Heather Schreiber. So you might remember that Heather Schreiber is our Social Security expert. Heather is one of the top Social Security experts in the nation, and I'm always excited to host her on a webinar. Today, our Financial 15 is going to be a continuation of our three-part portion of our three-part series for financial education for college students and young adults. And you might remember that this came about because I was asked to give a talk at my kids' college, local college here, about exactly that, financial literacy. This is a big topic. It's an important topic. So the Honor Society there asked me to do a presentation. And as I was building it out, I thought it would be really great to share with you folks. Now, I understand that you folks are, most of the people watching this live certainly are here for the really sophisticated stuff. You know, the information about, you know, what our analysts think, and some more sophisticated planning topics, and these Ed Slott updates, and talking about RMDs and IRMA and all this really juicy stuff. But it's also good to get back to the basics and remind yourself. Now, you're going to know all these things that I'm talking about as we go into the Financial 15, but these are critical items for our younger adults. As I was going through, when I was talking to my 17-year-old and my 22-year-old, and we're talking about what is a stock and a bond and how does it work and what are dividends, we're going to go over some of that today because it's really vitally important for our young adults. You know, I've sat with many of you from the camera or across the table, and no one has ever said to me, well, geez, I wish I would have waited a little while longer to do this. You know, whether it's saving, investing, Roth conversions, tax-efficient planning, nobody has ever said, I wish I would have waited longer. So this gives our children and our young adults an opportunity to learn some basics, maybe get inspired to start paying attention to things and start thinking of their money differently. One of the things I talked about last week was when you're dealing with banks and you're dealing with credit, you have to be really, really careful because those institutions will suck your money out away from you in the form of fees and interest rates. And, you know, sometimes it doesn't make sense to make that purchase just because you can, and pay attention to the little things. I shared that my daughter was using a plan that worked for her for a short period of time when she was much younger and starting to save, but they were charging her $5 a month. Well, that may not sound like a lot, but that's $60 a year. It builds up over time, and those little things can really cost you money. But I talked about that last week. So if you haven't already heard that, go back and listen to it. Share it with your grandchildren, people you might think would benefit from it. And we break these things down. This is going to be about 45 minutes or so, maybe an hour today. But we break them down into Financial 15s where they're 15-minute segments, or sometimes less. Sometimes if I go a little long-winded in the Financial 15, it'll become 2 segments of 10 minutes or something like that. So today we're going to talk about growing your money using stocks. And then next week we're going to talk about growing your money using bonds, mutual funds, and ETFs. And again, these critical items, and just giving them an opportunity to have a start. So I talked about inspiration and with our, for our young kids, but I want to also just touch again on my goals for you folks as our listeners. I want you to be inspired. I want you to be inspired to make changes. If you haven't yet gone down that path of, hey, I'm starting to learn about these tax-efficient planning strategies, and I've read about Roth conversions and maybe using life insurance as a tax-efficient savings vehicle, and what are the potholes and pitfalls I have to pay attention to, and how is the best way to handle this? Well, I want you to be inspired to start learning about these things and making these changes that will have significant potential impacts on your future and your retirement plan for you, your loved ones, people around you. So I'm always excited. I spend a lot of time talking to people who watch these videos or attend classes, and we do these follow-up appointments, and I show them these side-by-side comparisons of, hey, if you keep doing what you're doing today and taxes increase significantly, this is where you're likely to be. If taxes stay the same, well, this is where you're likely to be. But if you take steps to be tax efficient, this is where you're likely to be. So if you're just listening to me, I'm raising my hand higher because what I always see is that people come out way ahead in a tax-efficient strategy, and it can be life-changing for folks. Sometimes it's the difference between potentially running out of money and making your money last potentially for the rest of your life. Many times it's having millions of dollars more to spend during your lifetime, or millions of dollars to spend to pass to your heirs, if that's your objective, or if that's just what's left. And that is really impactful and really exciting. And I was just talking to somebody and they asked me, what drives your passion and what you do. And it's things like that. It's being able to show folks a path for having more comfort, more confidence, and just being able to relax more in their retirement and show them where they're going to have a larger nest egg. They're going to have a larger amount that they can leave to their heirs. They're going to have that comfort and that confidence, because if you have hundreds of thousands more, millions of dollars more during your lifetime that you can spend instead of sending it to the government, for most folks, it's a better situation. So I want you to be inspired to make those changes and learn more. And I want you to open your mind to different ideas and different ways of thinking about planning and investing. We do financial planning differently than most folks around the country. We do investing much differently than many, many folks. That's that. All these things are exciting to me, but I want you to open up your mind about different ideas of thinking about planning and financial planning and investing. I want you to stay educated so that you feel confident in the plan and strategies that you put in place. So even if we've been working together for 10 years or you've had your plan in place for, decades, continue to be educated by the right folks. We talked about some of these YouTube gurus that are out there that are giving out bad information. So you have to be careful who you're listening to, but I want you to stay educated and I want you to stay updated so you can make adjustments along the way. So they're really my goals for you with these webinars. So I'm going to try to remember to talk about those every time. And if I don't, I'll come back to them as much as I can. So let me share the Slott Report today with you. So I like to, if you're just joining us for the first time, the reason I share these on the screen, and I used to just read them, is that we had a client who said, these are really great. I love following along with these, but it would be easier if we could read them on the screen along with you so we're not missing things. So I always give Kathy credit for this. I want to thank you, Kathy, for that recommendation. But if you are just listening, a lot of people just listen on YouTube. They're on their treadmill or walking their dog, whatever you happen to be doing right now. Just follow along closely. And then if you want to go back and watch these in the video, on the YouTube video, each segment is indexed. So you can go in and you can look at those chapters, I think YouTube calls them. All right, so this is from our friend Sarah Brenner. And this is about 2 RMD strategies to avoid IRMA. So I talked about this at the opening, but this IRMA is the income-related monthly adjustment amount. And at the end of this article here, I'm going to show you where you can grab information from our website on IRMA. But that is the amount that really an extra tax you pay, an extra surcharge you pay on your Medicare charges if you're over certain income thresholds. And these are absolute cliffs. As soon as you cross over these income thresholds measured by modified adjusted gross income, you fall off this cliff to the next level. And that means you're paying more money for both you and potentially and your spouse if you're both over 65 and you're receiving Medicare benefits. So there are ways to avoid this, and we're going to talk about it. So Sarah writes, you have carefully saved for retirement, and now you've accumulated a substantial amount of funds in your IRA, traditional IRA. At some point, the funds that you have been putting away for years must come out. When you reach age 73, you must take a required minimum distribution, or an RMD, for that year and every year thereafter. You may be concerned about the tax hit that the RMD will bring. Besides the RMD itself being taxed, there is a ripple effect when an RMD is taken. An RMD is included in income for the year it is taken. A bump up in your income can negatively affect the availability of deductions and can impact the taxation of Social Security. That's a big topic that we talk about in our Changing World of Retirement Planning classes. I'm always surprised at how many people don't realize that your Social Security can be taxed, and up to 85% of your Social Security can be subject to tax. So the government gives it to you and they take it right back. One significant impact, a negative impact of an RMD may be increased Medicare cost. This is often not paid not paid the attention it deserves by many IRA owners until it's too late. So this is one of those things that sneaks up and bites you. First of all, there's a 2-year look back on this. So you may not, if you're 63 years old and you're not considering what the cost of the steps you're taking at age 63 are going to cost you at 65, this is something that can affect you. Because it's all based on that 2-year look back, and it's confusing. I understand, and it's also it's difficult to plan because I'm going to share with you a chart, but they're for 2024 numbers, which aren't going to be assessed. You're not, for what you do in 2024, you're not going to be assessed until 2026, and the thresholds are going to be different. So it is all very confusing, but it hits more and more people every year. And this is something you must pay attention to. And if you're listening to me and you're in your early 50s, mid 50s, maybe even early 60s, you may have not even been considering this thing called IRMA. You know you have an Uncle Sam, but you may not know you have an Aunt Irma, income-related monthly adjustment amount, that can greatly increase your cost of Medicare to hundreds of dollars a month, right? Can increase it by hundreds of dollars a month. Sometimes several hundreds of dollars a month per individual. You may also not be considering tax on your Social Security. You may not be thinking, oh my gosh, it feels like Social Security is a tax and then I'm going to be taxed again. Yeah, it can certainly feel that way, and it may not feel fair, but it is the law of the land, and it is how it is. And that is certainly something that is going to affect more and more people every year. And I'm certain we have a video on taxation of Social Security. So I'm going to take a note here, and I'm going to include that in the description. But if you're a younger person and you're not quite in retirement, if you're not past age 65 yet, and you may not know these things yet. So pay attention to them, because it has to be part of your planning, and not enough planners talk about these things. All right, so increased Medicare costs. So here's more discussion about IRMA. Without careful planning, your RMD can result in much higher healthcare costs. This is because the RMD is included in your modified adjusted gross income that is used to determine the Medicare Part B and Part D cost 2 years down the road. The income-related monthly adjustment amount, or IRMA, sliding scale is a set of tables used to adjust Medicare premiums. The higher the modified adjusted gross income, the higher the IRMA. There are no phase-out ranges. If you have modified adjusted gross income that is $1 over the limits, you will have to pay the full extra amount. This can be a significant amount. How can you avoid falling into the trap of higher Medicare costs due to RMDs? Here are 2 strategies to consider, Sarah writes. 1, convert to a Roth IRA. That's one of our favorite strategies, our Roth conversions. One way to avoid IRMA problems due to RMDs is to eliminate RMDs. Get them out of there. If you are in your early 60s, you may want to consider converting to a Roth IRA sooner rather than later. I don't know why Sarah put that in there. Maybe, maybe because I don't know why. But at any age, converting to a Roth IRA should be a consideration. You will want to get the conversion done before the income from the conversion would affect your modified adjusted gross income for Medicare purposes. Income in the year you turn 63 impacts IRMA brackets in the year you turn 65. By doing so, you can then minimize the impact of RMDs on Medicare cost. This is because RMDs will not be needed. RMDs are not required from Roth IRAs during the Roth IRA owner's lifetime. In addition, any qualified Roth IRA distributions are not included in modified adjusted gross income for Medicare purposes. So, and frankly, it doesn't matter. Even if you're past 65, even if you're 70 years old, it may still make sense for you to do Roth conversions, or above 70 years old. It may still make sense for you to do Roth conversions. Each individual is different, and you should evaluate it based on your needs. But as I said early on, we developed a calculator just to be able to look at this. Here's the effect, your overall cost. If you have IRMA charges for the rest of your life, and we plug them in using the information from the IRS, And here's the effect. If you pay higher IRMA during your Roth conversion years, but you never have to pay it again because your Roth conversions are complete. And as Sarah said, once they're in a Roth, there are no RMDs, and any distribution doesn't count towards IRMA. So we show that side-by-side comparison, and you have to look at the math. Sometimes, oftentimes, most of the time, it makes more sense. The math shows better, right? You pay less IRMA over your lifetime by doing the Roth conversions, even though it's consolidated in a shorter period of time. So it might be a little higher. So I hope that makes sense. But Sarah speaks to your early 60s you might want to consider. But you may want to consider this at any age. From 20 to 80, you should be considering these tax-efficient strategies. And I'm not putting a limit at 80 either. That's just a number that popped into my head. The second one, do a QCD. This is becoming more and more popular. It feels like every day, a qualified charitable distribution. If you already are taking RMDs, a qualified charitable distribution, or QCD, is another strategy you may want to consider to minimize the impact of RMDs from an IRA on Medicare costs. With a QCD, you can transfer up to $105,000 annually from your IRA to a charity tax-free. A QCD can satisfy your RMD for the year, and it is not included in modified adjusted gross income for determining Medicare costs. Keeping the RMD amount out of modified adjusted gross income can result in big savings. This is not the case if you are taking your RMD and then donate to charity and claim a charitable deduction. With that approach, the RMD would still be included in the modified adjusted gross income. So that is what's so great about qualified charitable distributions. They go direct to the charity, a qualified charity. They do not hit your bank account and then you write the check out. It is they don't pass go, right? They go right to the charity. It has to go right to the charity. You have to be over age 70 and a half. I know that's confusing because that used to be the RMD age, but they've changed the RMD rules twice in the past several years, but they've kept that qualified charitable distribution age at 70 and a half, which is good for us. It's good because it means that you can start moving money sooner. Be careful with charitable distributions, though. You want to make sure your needs are taken care of before you send money to a charity. This all can sound really exciting, and I want to do these QCDs, and I can move up to $105,000. But what if you need all or a portion of that to live? So you should do, of course, a financial plan to figure out what your needs, goals, and potential issues are before you start sending money to charity. It's a really great idea. If you can do it, send money to charity. I enjoy supporting charities, but you want to make sure your needs are taken care of. All right, real quick before we move on, I'm going to bring down and show you where you can get information about IRMA. I'm finding my cursor. Let me pull down our website here. Okay, good. So here's our Attleboro Wealth Management website. Over here at Education and Resources, you go here, you do this drop down, and you go all the way down to the Slott corner. So this is material about Ed Slott and his group. Click on that, and it'll open up the page for Slott Corner. Scroll down, and you can download tax planning materials for 2024 and 2023. And in that material, you're going to find this. Let's put this here. This is the 2024 Medicare income planning, and this will show you the brackets for Medicare. I'm not going to go over these right now. Again, I have a whole video for it. I just wanted to show you where you can find it if you want to. Required minimum distributions and qualified charitable distributions. This is today's mailbag. So Andy Ives writes this, and these are common questions. We just talked about qualified charitable distributions, Roth conversions, and how they can help avoid IRMA. But more questions about those kind of items here. So the first question is, my mother passed away in April of 2023, and no required minimum distribution or an RMD was taken from her account. The entire IRA account was paid out to a charity that was the beneficiary. Was there a requirement to take the RMD? So that's from Joe. The answer is, Joe, of course, condolences on the loss of your mother. Yes, she did have a year of death RMD, and the year of death RMD is the responsibility of the beneficiary. Since the beneficiary in this case was the charity, and since the charity received a full distribution of the IRA, then all is well. The 2023 year of death RMD was included in the lump sum distribution to the charity. That may sound easy, but these things, these little things like that can really confuse people when it comes to RMDs. We get questions like these all the time. So the next question, can a qualified charitable distribution be taken from an inherited IRA? I have my own traditional IRA that I've been taking QCDs from, qualified charitable distributions. If I take the QCDs from my inherited IRA only, do I need to wait to take my RMD for the traditional IRA until after the QCDs have cleared from the inherited IRA? Whew, there's a lot there. So, and this is another example of how confusing RMD rules can be. This poor person says, all right, wait, I want to use this QCD rule. Now I've got my own IRA. Now I have an inherited IRA. And one of the best planning things that you can do for yourself, if you have any chance of inheriting an IRA from your parents, is talk to them about converting those funds to a Roth IRA. I wish if I could wind back the clock, well, there would be many things that I'd want to do if I could wind back the clock to help people out. But this is a big one because sometimes people get hundreds of thousands of dollars or more. Sometimes it's substantially more in inherited IRAs, and now they're stuck. You can't convert an inherited IRA to a Roth IRA. The rules don't allow us to do that. But so you have very limited options. You can do a qualified charitable distribution. That's a tax-free distribution. You can draw it down as soon as possible, but you're really stuck with this tax inefficient time bomb that's going to create issues for you. Most folks help their parents with their finances as they age, or they have some idea what's going on, but talk to your parents about converting these funds to a Roth IRA. They might be in a lower tax bracket than you, and that would be beneficial, of course. But even if you're in the same tax bracket, it's likely going to be better for you. So anyway, have that conversation. But in this case, this fella has an inherited IRA and his or her own IRA. So the answer to the question is inherited IRAs operate completely independently from a person's own IRA. Keep that, lock that in. Different, they're different. They have to stay separate and different. They can't be aggregated for RMDs, and they're treated very differently. So inherited IRAs operate completely independently from a person's own IRAs, meaning RMDs between the two cannot be aggregated. Distributions from one account have no impact on distributions from the other. As such, you do not need to wait for any transactions to clear from one account before transacting on the other. Assuming you meet all the normal QCD requirements, like being age 70 and a half, then yes, QCDs can be done from your inherited IRA. As mentioned, the timing of these QCDs has no impact on the RMD requirements from your own IRA. The only overlap is that the total annual QCD limit is $105,000 for 2024, aggregated across all IRA accounts. So that's the only thing that aggregates is the total amount of that qualified charitable distribution. So that was a good answer. Good question. All right. Now let's talk about our analyst reports. So we talked about this last week, but consumer price index came in higher than expected. Last week, 3.5% year over year, above the 3.4% gain. So a lot of people are blaming the drop in the markets last week and even the week before on this. There's a lot of other things going on too. You've got conflicts all over. It seems like all over the world. And this is certainly sticky inflation. And it's not so much that it was just 0.1% higher. It's that it is pretty consistent. And the question is, how long is it going to be here? And the reason it would have an effect on the market, and it definitely played a role, I think, in the downturn we saw. There's a few things. So we're seeing all-time highs. So we expect a pullback when we see that. And we have these conflicts. We're worried about Iran attacking Israel and that continued conflict in Israel and Russia and Ukraine, and we've got an election coming up, and that's been surprisingly doesn't have much effect on the markets, but that'll probably heat up. But again, we're at these all-time highs, and people are pricing in the markets, the analysts and investors as a whole, whether they're individual retail investors or whether they're professional money managers, they're pricing in these rate cuts from the Fed. And when we see that the inflation is not only not decreasing, but it's ticking up slightly, well, that reduces the likelihood that we're going to see rate cuts. And certainly in the number that were expected. Remember, in the beginning of the year, the end of last year, we're talking about 4, and we were talking in June. Well, it's April 16th. It's very, very unlikely we're going to see 4, and also very unlikely, I think, that we're going to start seeing any cuts in June. So the odds for a Fed cut in June fell from 56% to just 30% right after that report. So it's highly unlikely, and we really could be sitting here without any rate cuts by the end of the year. So that'll that optimism that we have for the markets based on rate cuts could really slow. The producer price index, so wholesale level prices, increased 0.2% month over month, and that was below the expectations. So we had and that was 0.1% below the expectations. So again, slightly lower at where consumer price index, so what people pay for goods generally, was slightly higher. But the producer price index was higher than the month before. So lower than expected, but still higher than the month before. Hope that makes sense. So the wholesale inflation continues to look better than the consumer level, this consumer price index. But it does add to the argument that the Fed will push potential rate cuts off till later in the year, if at all. Let's see. We have a leading economic index indicator coming out on Thursday, so we'll see what that gives us. See if we're still heading out of recession territory and what the growth story is there. But let's look at markets in the last week. So as of the close on Friday, the Dow Jones Industrial Average was down for the week, 2.37%. So it took the year-to-date return on the Dow at just 0.78%. As of Friday. The S&P 500 was down 1.56%, so that gives us a year-to-date return of 7.41. The NASDAQ was down 0.45%, and that gives us a year-to-date, as of Friday, of 7.75. The small companies, the Russell 2000 measures the top 2,000 small companies in the U.S. roughly, was down 2.92%. So that turned the index into negative territory. So that for the year is down 1.18%. Bonds have turned negative. That was down 0.70%. And I shouldn't say turn negative. The year to date, bonds are down 2.52%. So still struggling in that what we call fixed index market, that bond market. So driven by interest rates. So, and as far as analyst reports, let's talk about, I want to just share some thoughts that I thought were interesting from BlackRock. So this is specifically, BlackRock's a huge organization. I think they're the largest money manager in the world. Hello, Doug. I just saw your comment. Sorry. It is a beautiful day. But this comes specifically from the BlackRock iShares department or section. So iShares are their ETFs, exchange traded funds. I thought this was interesting, and sometimes you do get variations from different areas of their investments. So let me read to you a couple key takeaways from BlackRock here. So our base case, they write, is that the Fed engineers a soft landing and starts to cut rates in the second half of the year. They said our base case, not our best case. So I read that a couple times because I thought, boy, that's pretty optimistic. But they're saying they're still believing that. The downside risks to economic growth have diminished. So the risk of only 2 Fed rate cuts now appears higher than the risk of 4 cuts. I think that's interesting. So they're basically saying we expect there's going to be 2 rate cuts or maybe 3, but not 4. It's just an odd way of saying it. So solid economic growth, normalizing inflation, and a strong labor market may reward fixed income bond investors for owning bonds with duration around 5-year part of the curve. So that's really shorter. Most people own bonds that are maturity of 7 to 9 years. So that's where you get the further you go out, the more volatility you get. And bonds are very volatile. The bonds, listen, folks, for the past few years, bonds have been one of the toughest parts of the market. We believe the resilience of the quality factor is not limited to stocks and other asset classes such as corporate credit. We believe companies with resilient balance sheets and strong fundamentals are likely to continue outperforming their unprofitable counterparts. I want to remind you that this is simply an analyst report, and this is not any recommendations to buy, sell, or hold any specific securities. They write international election uncertainty, monetary policy disparity, and gradual impact of structural trends such as nearshoring all point to a year of elevated global disruption. We think this presents investors with distinct opportunities by evaluating their options in both international stocks and international fixed income. So interesting. That's an area that we do find most people, when they come to us, they're underallocated to international, whether they're very U.S. focused, and that's fine, but you do want exposure around the globe. I was just listening to, while I was preparing this today, I was listening to a speaker on CNBC about the inflation in the EU and how it's adjusting better than in the U.S. and all the reasons around that. So it is important to have a global outlook. They write, we believe that the Fed, again, BlackRock, we believe the Fed is likely to cut rates in 2024, but cautiously. This was interesting from this group. Now, again, these are exchange-traded funds, which are typically passive investments. So the exchange-traded funds tend not to have active money managers. There are exceptions, of course. But BlackRock, in this group in BlackRock for ETFs, they write that, I'm just trying to pull out the best words for this, because this is all about advisors should do this, advisors should do that. Experienced active managers can build a high-income seeking portfolio that manages risk and is well diversified across multiple sources of return in markets like European credit, emerging markets, and securitized credit. So that was interesting because they seem to be saying that active management in this area, this bond fixed income area, is probably this is the way I'm reading, is a better position than passive management. Now, I would argue that all day long, by the way, and that's why specifically we have bond holding or bond active management mutual funds in our holding, as opposed to exchange traded funds. So I'm surprised to hear the exchange traded fund department say that. So that's good. More objective opinion. Okay, so they go on to talk about stocks and international, but let's just see. Okay, so there are two sectors they did talk about in stock that I think are important. So they talked about communication services, and they write between 2021 and 2024. This talks about revenue per share. That can be a little. So they're saying this sector increased at an annualized. This is the revenue per share at an annualized 10%. But in the first quarter of 2024, we saw that revenue growth jump to 15%. They write that we believe this spend will continue to show up in earnings for this sector over the next quarter. So again, they're being very focused to the shorter term in stock, which you should be more focused in the longer term. But I think it's interesting when they zero in on things like communication services, and they're also talking about financials. And they talk about the financials in the shorter term because we're seeing a lot of trading activity, and we're seeing capital market activity, so they're just pulling out those two sectors. So be cautious of sector investing, because again, when you're reading something, if you find this if you're searching analyst report, and anybody can pull this up. This is not just something that you have to be a financial advisor or some sophisticated investor to pull this up. You can pull up this BlackRock analysis, and you suddenly see that communication services, well, hey, the revenue per share is usually at 10%, and it really jumped in the first quarter of 2024 by 50% to 15%. Maybe this is a good area to be investing in. Well, that's not what I'm saying. I'm giving you an example. What I'm saying is these are very short-term looks at different sectors. And you should not be investing in the short term. You should be investing more in the longer term. We pay attention to these things, but not even, it's really to gauge what's going on in the markets, not to make individual changes in the portfolios. We handle that in a completely different way. So I hope that makes sense. But what do you do with this information that you read, either on the internet, you hear from folks on YouTube, you hear from me, you hear from these different people. What do you do with this? Well, listen, it's good for education and it's good to know what's going on, but you really shouldn't be making investment decisions based on what analysts are saying, because I'll share with you many times that one analyst says, that wall is black, and the other analyst says that wall is white, or that, it's this is what we're seeing in the stock market, and the other one might say, well, this is what we're seeing in the stock market, so we're going to overweight bonds. The other one's overweighting stock. So how do you deal with this? Well, you let your plan drive your investment decisions. You should have a system of principal protection. Some part of your portfolio should be at a point where it can grow, but it will not lose less than your floor should be zero. Can't lose any of your principal in any given year. So the options for those kind of strategies are expanding, so that's good. But you want some good growth opportunity, and you want that principal protection. You also want what I believe is the account segmentation, where you have you know exactly when you're going to need those funds and invest those funds accordingly. And of course, that comes from the plan. So that's how you handle this confusion. Well, what happens if the Fed doesn't cut rates? What's going to happen to my portfolio? Well, it shouldn't have an impact on your spending and your goals and what you want to do in the short term, because really that should be invested in very safe money that should have very, very low risk of loss, if not zero risk of loss. But again, you want a strong foundation. You want to make sure that your investments are driven by your plan. You've got your principal protection and ideally your account segmentation. And you want that foundation to be. I use the example of the buildings that are built in earthquake zones, where when there's an earthquake, you'll have some cracking of the buildings, but they should not crumble completely. If there's some tremors. So I hope that makes sense. All right, let's go into our Financial 15 here. So this was the first time I've used Google Slides instead of a PowerPoint. So I'm going to, and it works pretty well, frankly, but it is a little bit different. But this is the Financial 15 segment of our weekly webinar, and this is a continuation of what I started last week. And if you haven't seen that, you can go to part 1. And if this is the first time joining us on the Financial 15 or on this YouTube channel, you can hit the like, subscribe, and notification buttons so that you always receive notifications of our upcoming videos. And we do break these into different segments. So this last segment is usually about 15 minutes or so. Sometimes it goes a little longer, and if that's the case, we'll break it down. But this discussion about financial education, or essential items for younger adults, college students, and young adults, really came from a presentation I was asked to give at a local college about financial literacy. So you've heard me say this if you started with us in the beginning, but I was really inspired by some of the feedback and some of the questions I got from the students in the class. And I was really motivated as I was putting this presentation together, and some of the conversations I had with my own kids. So I thought I'd share it with you. And if you're a sophisticated investor, you can share this with people you love. And if you're a young adult just learning for the first time, I'm happy to share this with you. But this section is called Grow Your Money. So we talked in part 1 about banking and the fees involved with banking, and so I'm talking about account fees and the interest rate that you can earn in banking with your deposits, when you put money into a bank, and the different options that are available to you, money market CDs, things like that. And I always stress, get as much interest as you can when you're talking about your deposits. Be careful and know when you're going to need those funds, but get as much interest as you can. And then when we're talking about debt, whether it's credit card debt or some kind of loan, pay as little interest as you can and be really, really careful with that interest, because it can absolutely just steal all your money away. And I just referred to it as stealing your money away. And it's really important to know what you're paying for things, the total amount of cost with the debt cost. It's really important. And of course, those account fees can chisel away at your money as well. But now we're going to talk about how to grow your money. And in this first section, we're going to talk about stocks. So what is a stock? And the analyst reports that we were just going over in our weekly webinar, I was reading these analyst reports, and some people say they should overweight stocks in different parts of the world. And some other analysts say we should overweight bonds in different parts of the world. And we talked about, kind of how to work through that information and that muck. But the basics are, what is a stock? How do you grow your money, and what does it really mean? And when I asked this question, there was a fellow who, a student who raised her hand, and they said it's a partial ownership in the company that you invest in. And short answer is yes, that's exactly it. A stock represents a share in the ownership of a company, including a claim on the company's earnings and assets. As such, stockholders are partial owners of the company. So not a recommendation to buy, sell, and hold, but if you really love Apple, well, you can be owner of Apple. If you really love Google, you can be a part owner of Google just by buying the shares. And it's never been easier than it is today. When I was in my 20s and I wanted to buy a stock, I think it was America Online, if you remember AOL.com. I reached out to a broker, and I had to have a certain amount of money, and I couldn't buy it online because that was just starting. It was a bit of a process, and you had to have a good chunk of money to invest. And I remember the broker I reached out to, my mother-in-law, who works with us now, actually worked for him at the time. He said, "Mark, I'd love to put together this different portfolio for you over time, but you're really better off just buying a mutual fund." And we're going to talk about mutual funds and ETFs at our next segment, our next week. But it is so much easier now. You've got platforms like Robinhood and, all these different, I was about to say TD Ameritrade, but Schwab bought TD Ameritrade. So you got things like Robinhood where you can, and I'm not recommending Robinhood, but you can buy fractional shares. You can set up an account easily online. So make sure that you have a strong custodian that has good reputation, that isn't going to disappear with your money. But it's much, much easier today to buy stock, and you can set it up online, and you can buy it. When I say cheaply, I don't mean the price of the shares. I'm talking about, for a few $100s or less, you can start investing in stock. So when the value of the business rises or falls, so does the value of the stock. Makes sense? And there are two different ways to grow your money in stocks. First of all, we have dividends. Some companies pay dividends. And some companies don't, and you're just subject to the price increase or decrease. So you can grow your money by either dividends and or price increases. This, when you're talking about stocks or even bonds, for the most part, this is longer term money you're not afraid to lose. Certainly when we talk about bonds, and that's next week, but when we talk about bonds, that's also money you're not afraid to lose, because the bond market can be very, very volatile. But of course, with stock, listen, we've had some great growth in the stock market. Different companies have grown very, very well. I'm going to show you some examples in a moment, but there are companies out there. I use the example of America Online. They really don't exist anymore. So if you invested a lot of money in America Online, it's likely you have none now from that investment. I actually don't. Is there any iteration of AOL that is still available? I just don't know. So you're going to see some disclaimers on the bottom of every one of these slides, and it's just in case I forget to say it, but stocks also have a risk of loss of your investment. So you can gain quite a bit, or you can just gain a little bit, or you can lose also. And you can lose everything. There is no protection in individual stocks. If a company goes out of business, goes bankrupt, then you can lose all your money. So General Motors is a really good example. You can still buy GM cars, right? So Chevy, General Motors vehicles, but during the Great Recession, right, the financial crisis, General Motors filed bankruptcy. So if you had a significant amount of money in GM, you lost it all. So again, long-term money you're not afraid to use is what you should be looking at for your stock investments. So let's first talk about dividends. A dividend is the distribution of a company's earnings to its shareholders and is determined by the company's board of directors. Dividends are often distributed quarterly and may be paid out as cash or in the form of reinvestment in additional stock. So you can choose to reinvest the stock. That's what a lot of people do during their growth phase. And then a lot of people, when they're retired, choose to take distributions from their stock in the form of dividends. So they receive it back and they spend that cash. So it can be beneficial both ways. It can help build up your stock portfolio if you're reinvesting those dividends. And then when you want to start drawing income out of it, you can kind of flip a switch and start receiving dividends. So you'll see that this definition came from Investopedia. Investopedia is one of my favorite resources for general knowledge about investments. So you can search anything from stock dividends to stock option strategies, and you can find some good information on Investopedia, basic information on there. So I wanted to reference that. Here's an example, again, not a recommendation, but I wanted to use an example of something that's recognizable for people. So this is an example using Verizon. So Verizon currently pays a 6.32% annual dividend. You can either reinvest or receive the dividends in cash, as we talked about. And again, this is an example, not a recommendation to buy, hold, or sell a security. But you might be thinking to yourself, well, hey, that's great. I'm going to run out and get Verizon. I like that 6.32%. That's a little bit better than I'm getting in my money market. You're probably today, here we are, May 16th, 2024. You're probably getting somewhere around 5% in your money market. You might say, well, that's over 1% better, or I'm going to run out and buy some Verizon and get that dividend. Well, you got to be careful because pay attention to price. So here's what happened with Verizon. So this is from Google. I just Googled Verizon and looked at the stock price, and you'll see. Let me see if my laser pointer is working here. This is using a 5-year period. Well, 5 years ago, you said, "Oh, I'm going to start buying Verizon because I like that. I like that dividend that I get." Well, you haven't had a great experience. You've lost about 28% of your investment over the past 5 years. So I'm showing you that, again, not to recommend against buying Verizon or for buying Verizon. I'm showing that as an example because it's not all about the dividend. And you also have to look at the different time periods. So this is 5-year period. Now let's look at over the past 1 year. Here's the same company. We're looking at price because remember, you can grow your investment by dividend or price, or often a combination. But this is price. Over the past year, Verizon grew 2.77%. So that's just the price growth. 2.77% over the past year. So it really depends on what your objectives are, what your timeline is. Remember, when you're talking about stocks, this is money that you should not, you're not afraid to lose it if you invest, whether it's $100 or $1,000 in a company like Verizon, and it increases 2% and you get some dividend also, that's great, but it could fall. If it falls in price, you'll likely still get your dividend. I say likely because they can suspend dividends at any time. They can reduce or increase dividends. And when I say they, I'm talking about the board of directors. So now let's talk about, here's another example. So I wanted to find another stock that I thought people might recognize. I think most people recognize Apple. Trades under this symbol. This is what's called a ticker symbol. So you can just Google or search, I say just Google, but whatever search engine you're using. I've read that Bing's becoming more popular now because they have a strong AI component in their search engine. That's pretty interesting. But this ticker symbol here, this AAPL, and what we saw previously with Verizon, this is the ticker symbol, VZ. That's how these things are tracked on stock exchanges. So you've got this AAPL, and that represents the trading symbol for Apple. So over your year to date, you might look at this and say, well, geez, Apple's not a good investment. It's down 8.65% year to date. Well, you don't look at it in a vacuum, not just in a short period of time, because again, your stock investment should be investments you're going to hold over a longer period of time, at least 3 years plus, 5 years or more, but think even longer. So that's just year to date. So that's as of a couple weeks ago when I prepared this presentation. But let's look at Apple growth over 5 years. So over a 5-year period of time, we're at 241% growth. That's significant. So over the past 5 years, you had significant growth. So when you're evaluating the companies that you're looking to purchase, if dividend yield is important to you, and that could be important for your growth also, you might say, well, I want a company that is just based on price growth. And the reason a company like Apple doesn't produce dividends, or may not produce dividends, is because they're reinvesting in the company. A company like Verizon wants to give value to their shareholders in the form of dividends. So it's just a different strategy at different times in a company's life, or just generally a different strategy that a company may have. But look at not only the short term, but also look at the long term and see how it fits in potentially to your investment portfolio. And again, I just have to say that these are examples only, not a recommendation to buy, hold, or sell a security. So I don't want any folks, whether they're your grandchildren or a random young adult listening to this on YouTube, saying, hey, I bought Apple because you recommended it, and now I've lost money. That it is not a recommendation to buy, sell, or hold a security. So let's look at what would have happened using Apple as an example, because again, if you just go back to year to date, it might scare you, but you want to think about long-term strategies. So if you looked at Apple, and what I did is I went back and I said, okay, what was the price of Apple, or what was the average return of Apple over the past 20 years? And the average return of Apple over the past 20 years was 37%. That's the average return. It's had high years and low years, but that's an average return. So then I took the starting with a zero balance, and we invested $50 a month over 20 years. That's a total investment of $12,000. And if Apple earned, as an example, if Apple earned an average of 37%, how much would you have in value at the end of that 20 years? So let me just frame it again. You start at zero. You start investing $50 a month. In this example, Apple or any security that has earned 37% over the past 20 years. Your total investment over that 20 years is $12,000. Your value at the end of that 20 years is $2.3 million. $2,370,726.32. Exclamation point, exclamation point, because that's exciting. And the reason I wanted to point that out to you is that if we go back to these charts and graphs, it can be like, oh, well, some of them are up, some of them are down. I don't know what the heck to do. I don't know when to buy. Folks, it's about consistency. It's about consistency in your process. It's about consistency in your investing. It should be automated. It should be something that you do on a regular basis. And you should, you can do one of many, many different things. You can learn how to analyze companies and find an Apple or something that works for you. You can, I'm going to talk next week about mutual funds and exchange traded funds, but there's a lot of different ways that you can figure out what to invest your money in, but the key is to do it consistently. So what I wanted to show you with this was $50 a month. That might be a little or a lot to you. I don't know. You can use your own number. The good thing is you don't have to have a financial calculator. You can just do a search. You can do it using artificial intelligence. I had a lot of fun using AI to put this presentation together. So you can use that artificial intelligence to figure out, if I only invest $5 a month, what does it look like? But, many of you can find $50 a month to invest instead of spend somewhere. And I wanted to show you the impact of doing that over a longer period of time and what you could have in the future if you did that. So over $50 per month, over 20 years, your total investment is $12,000. Your value is $2.3 million. I think that's exciting. So that is the program for today. Next week, we're going to talk about how to grow your money using bonds. And we're also going to talk about exchange-traded funds and mutual funds. And we're going to talk about what they are. So I hope you found this Financial 15 helpful. This was a basic, part 2 of a basic education course around some financial essentials for young adults. Again, last week we talked about banks and bank fees and interest and the cost of credit. In this segment here, we talked about basics of stocks and growing your money using stocks, whether it's price or dividends. And next week, we're going to talk about bonds and what bonds are. And we're also going to talk about exchange-traded funds and mutual funds. So I hope that was helpful. If you have any questions, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you haven't already, hit that subscribe, like, and notification buttons. And I would appreciate the subscription. I appreciate the likes. And with the notification, you make sure that you're notified as soon as we release a new video. If you want to go through our website and see what we have on there, you can find us at attleborowealth.com. That's attleborowealth.com. That's it for today. I hope you all have a great week. If it's beautiful where you are, get outside, take a walk, and enjoy it. Take care, everybody. Have a great day.